So the markets have been fairly volatile over the last month and a half. Ever since the budget, there has been this sort of fear in the markets that the markets could, correct. The markets are down 8-10% already, and there are two big concerns that are troubling investors. One, that the Indian economic growth is slumping, and second, that the global economy is also weakening, and the threat of a full-blown trade war between US and China, which could actually trigger sort of a global recession. Now let's take a step back and look at these concerns. Yes, Indian economic growth seems to be the weakest we've seen in nearly a decade. There's a major slowdown in major parts of the economy: autos, banking, NBFC, real estate. Now all this in the backdrop of rural incomes which are already weak. Now these are major sectors which have a multiplier impact on the economy. Multiple reasons why this slowdown seems to have happened. You can't exactly pinpoint, but I think, and I won't spend too much time discussing economics here, but a couple of well-known reasons. One, of course, is that NBFC started cutting back lending last year, which had a major impact on small businesses and also consumption. The other is that the government spending also didn't grow as tax collections were significantly short of target last year. This was really led by GST. The other issues like tax on FPIs or foreign portfolio investors or super rich tax, I think, are more sentiment dampeners than the real reason to sell, or the real reason that the sell-off happened in equities. Now the slowdown also means that profit growth for Indian companies remains elusive. The consensus few months back in March, April was that profits for the Nifty companies would grow about 20% this year. We're already seeing forecasts being cut now to the range of 12 to 13%. The way the slowdown is unfolding, it could actually end up being in single digits. The other big reason for increased risk aversion is now more global, which is the heightened trade tensions between the US and China. This trade war, if it actually escalates, can have major ramifications for the global economy. China is the single biggest part of the US supply chain, and any uncertainty on tariffs will cause businesses to pull back fresh investments. Not good. But what's the real possibility of a full-blown trade war? My view is that, rhetoric aside, chances are very, very low. Trump faces re-election next year, and he wouldn't want to jeopardize his re-election chances with a weak US economy. But he has to play to his audiences, and therefore, you'll hear these noises and, some action here and there. So the real question we face as investors are, how long will this last? Can the markets fall further from here, and by how much? Is there anything or something that we should do given the situation? Let's consider these. I think, barring any meaningful government intervention, our view is that slowdown could possibly persist for another 9 to 12 months easily. Can the markets fall from here? In a really bad scenario, the Nifty could actually drift down another 5 to 10% over the next 12 months. But there's one catch. Pessimism seems to be the consensus view right now. And the 25 years that I've been active in the markets, I have rarely ever seen the market move in the same direction when there is near unanimous consensus. Right now, everyone in the media only seems to be talking gloom. Headlines like today, where car sales crashed 40% last month. This, of course, is a wholesale number, not primary sales. But there's a significant chance that this negative outlook is already in the price or in the stock markets, priced into the stock markets. Any surprises could only potentially be to the upside. The other is that, let's say markets do actually drift down 5-10% from here. One option is that maybe we can reduce exposure to equity mutual funds. Any attempt to time the market is fraught with risk, as we have seen. An investor would not only need to sell now, but also buy back the market near the bottom. So let's understand the impact of this whole process. Our recommended portfolio has less than 40% exposure to equity mutual funds, which is the only portion linked to the day-to-day market. So to capture a 5-10% fall perfectly, meaning selling today and buying at the bottom, will mean an overall portfolio impact of 2 to 3% only. That is, if one is able to execute perfectly, which we know is humanly near impossible. And if we fail to execute perfectly, the whole exercise would be in vain and would end up actually costing us. This reminds me actually of the market situation in 2002, where the economy was in a very poor situation. Several industries were struggling, and we had a huge NPA problem in the banking sector. But we all know that 2003 marked the beginning of one of the biggest bull runs in the history of Indian markets. I know people who exited the markets at the Sensex level of 3,500 odd, saw the markets go down 20%, didn't buy. Markets started coming back, came back, they kept waiting, were unsure, eventually ended up entering the markets at 4,500 to 5,000 a year or two later. not a happy situation. We would want to do that to save at best a 3-4% on the portfolio. We are in equities to enjoy the long-term rewards that come from patient investing. Just to refresh our memories, here are charts that we shared with you during the financial strategy presentation. These are rolling returns for holding periods of 1 year, 5 years, 10 years. As you can see, economic and market cycles are routine and will continue to recur. For our clients, we are working with 10 years and longer strategies. In the context of this time frame, it simply doesn't make sense to try and time this correction. The India story isn't over. There's been a blip, not the first, nor will it be the last. Nor are we sitting on the peak of a massive bull market which has gone up 3-4 times in 5 years. In those situations, an exit call would be more structural and appropriate. This is not such a situation. In fact, when the markets do come back eventually and demand does come back, we've had a situation where for the last 10 years we haven't had any capex, and therefore when demand does come back, you could see a significant growth or a profit growth cycle which could mirror somewhat what we've seen in the 2003-2007 cycle. Now we know it's a difficult environment today, but having weighed the odds, we would choose to remain invested and continue to invest as usual. As a parting point for those clients that don't have a plan B in their portfolio in place through structured products, and not just structured products, but to the extent of 30-40% of their portfolios, this is the time to review it once again. Structured products have been the perfect antidote to such markets. Thank you.